Good morning and welcome to the Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Brian Gardner, Senior Wealth Manager at Velocity Investment Partners with Raymond James, will be joining us for the hour. In 30 minutes, we'll be joined by Sean McCormick, Vice President of Business Development and Data Services at Moneris, to discuss the economic impact of the NHL playoffs. And of course, we want to hear from you this morning on First Call. Reach out with your questions on North American large cap stocks, and we'll have Brian answer as many of them as she can at the end of the show. The number to call, 1-855-326-6266. We'll open the phone lines in about 30 minutes from now. Our email address is firstcall@bellmedia.ca. And now, some of the stories we're tracking for you in the BNN Bloomberg newsroom. U.S. President Donald Trump says a deal with Iran may be nearing as a ceasefire between Israel and Hezbollah in Lebanon boosted hopes for broader peace. Trump says Iran has made new concessions and suggested a renewed truce may not be needed. Though officials say a full agreement could still take months. Oil prices eased on the news, with Brent crude falling even as markets remain focused on the closure of the Strait of Hormuz. Netflix shares are tanking in the pre-market, off by more than 10% right now after the company issued a weaker than expected outlook and announced co-founder Reed Hastings will be stepping down from the board. Netflix's forecast second quarter profit below expectations and projected revenue that also missed estimates. The company says its plans to boost spending on content and expand sports programming, even as leadership emphasized discipline following its failed bid for Warner Brothers. Alcoa shares are trading lower, slightly, or 1.5% after the company's earnings and sales missed estimates. Operational disruptions like maintenance outages and supply issues linked to the closure of the Strait of Hormuz weighed on the results. Alcoa says higher energy and freight costs offset stronger demand, even as the conflict curbed production in Middle Eastern aluminum hubs, including the United Arab Emirates and Bahrain. And now our top line story. The S&P 500 is on course for a third week of gains of more than 3%, marking a sharp turnaround as signs emerge that tensions between the U.S. and Iran may be easing. Optimism over artificial intelligence and robust earnings have also been driving the momentum. Let's bring in our guest for the hour, Brian Gardner, Senior Wealth Manager at Velocity Investment Partners with Raymond James. Brian, thanks as always for joining us.
Yeah, thanks for having me.
Last time we talked, I think the markets were down. They're not so down right now.
Yeah. You know, we have seen quite a volatile first few months to start 2026. For us, it was expected, especially coming off the back of a little bit more muted of 2025, right? We only saw pretty much one correction, that April sell-off, and that was really the concerns over Trump and the tariffs of, his board of tariffing, 100, 300%. And that's really what caused that short-term sell-off in 2025. Now, headed into 2026 is a little bit of a different story. There's a lot of noise. It's not just the geopolitical risks right now. Obviously, that's front and center for a lot of investors, right? What is happening with this Iran-Israel-U.S. war? What is the resolution? What does that look like? What are the impacts on the economy? But it's also, what does the next part look like? Can we see this next leg up for the S&P 500?
Can you tell us what the next leg looks like? It's been quite the run.
Yeah, we are still, I would say, overall optimistic for 2026 from a finishing perspective. Do I think that we are going to continue to see volatility in the market? Absolutely. I don't think we're out of the woods just yet. I do think we are starting to see a change up of leadership, though, which is good for the markets. We had a little bit of reset. The markets pulled back, 9%, not even a double-digit correction. And we did see investors shift sentiment, which is important to note. We saw volatility spike aggressively. And it is now becoming a little bit more of an active management because not all sectors are participating. We're seeing about 50% of stocks above their 200-day moving average and still about only 4% hitting all-time highs. So that's not every stock is participating in this recovery.
Okay, going back with the volatility, where do you see more volatility coming from? Or is there...
Yeah.
Obviously Iran is still a big question mark.
Yes, I think, right now, the one thing that markets don't like are the unknowns, right? When is this going to resolve? What does that look like? And there's talks and they're making progress. And yes, that's all positive, and the market is forward looking. So it will price in and rally ahead of even a resolution happening. But there's still a lot of noise in that we expect for the next at least 4 to 6 months. That's going to be Fed changeover. We're seeing that, May, Powell stepping out. We're seeing new Fed chair in June. Interest rate direction, interest rate cuts that we had originally have reduced because of this short-term spike up in energy and oil that could potentially have impacts on inflation that now have reduced Bank of Canada and even the U.S. rate cut direction. So we will likely see that continue to play out. And also U.S. midterms is a big one. So we're starting to see that pick up, but that will still create short-term volatility in the market because there is a lot of moving pieces right now.
All right, with the Fed, do you think it's going to be as big of a change as some people have thought it may be, or is he going to pretty much fall in it? And I mean, it's a group of 12. It's not one person, right?
Yeah, I mean, I think we are all happy to see that, a president isn't solely determining where the direction of the Federal Reserve is going, that there is still a group, which is great for the U.S. economy and the direction and to make decisions. At the start of the year, there was pricing in potentially 3 to 4 rate cuts out of the U.S. Now with the short-term spike up of energy and oil, that rate cut decision has pretty much reduced to potentially 1, and that would obviously be in the later half of 2026. So if there is a resolution, inflation pulls back short after we get to this war ends and inflation cools again, we could start to see more cuts come on the table for the U.S. Again, the later half of the year, but that is where our expectations are of where I think the direction of the markets are headed.
And then, of course, we have, Kuzma. We still have those talks. What kind of a factor do you think that will be?
Yeah, I think that's certainly going to be an impact on Canada. I do believe we're in a recession right now, a technical recession. We saw Q4 GDP was negative, likely going to get Q1 negative. And you're starting to feel it. You're seeing consumers slowing spending. You're seeing that, tightening the belt. You're seeing their paychecks not go as far with the cost of goods, food, services, et cetera, layoffs happening. And I do think that we probably will get additional tariffs on a lot of Canadian goods that will impact the Canadian economy. So I think Bank of Canada is being strategic, they're being patient, and they're waiting to see that impact of these tariffs and how they will impact Canadian consumers. Because realistically, the interest rate cuts is the last tool we have in our toolbox to be able to sustain Canada from going into a deeper recession. So once we get these cuts, it will be, up to Bank of Canada to determine how quickly they will, or these decisions on these tariffs, it will be up to Bank of Canada to determine how quickly they will make those cuts. But I do see more rate cuts for Canada, but on the later half of the year.
Because we saw at one point, we saw a turn saying we might see 2 increases. Did we not talk about 2 increases? But that was so last week, wasn't it?
Yes, I think that's short-term mindset, to be honest. I think you're seeing that because, again, of this inflated spike of inflation. It's not long-term inflation isn't going up. It's when this resolves, oil will pull back drastically, will be the first sector to roll over. And we saw that short term already. And that will cool inflation again. You're going to see, sure, in the data, we're going to see a spike up in inflation, might cause investors to panic. But again, that's short term. Maybe we see it for 2, max 3 months. And then we will see that cool again. And then I think you will see interest rate cuts come back on the table again later half of 2026. And that's where the Bank of Canada will make those decisions to help the Canadian economy really get out of this stump that we're in.
All right, we're going to take a break on that note there. But up next, we'll take a look at the markets before the bell, and we'll see whether cash is still king. See how things are shaping up on the markets, and we'll start with U.S. futures, and all of them in the green yet again. They're going to close out the week. It's been quite the run over the last 3 weeks, gains of 3% a week at times. NASDAQ, I think, is up 14% in that time, and approaching record highs. Look at the Dow over 49,000, the S&P 500 over 7,100. Everybody's up right now. Looking at the Asian markets, though, we have a sell-off, taking some profits. Everybody down. The Nikkei down by 1.75, Hang Seng by 0.9, and the CSI 300 by 0.17. Heading over to Europe, and a bit of a mixed bag. CAC Caron and the German DAX up by 0.48%, but the FTSE is off by a quarter point. TSX finished down. It was one of the ones finishing down yesterday. I think it might have been one of the only ones that finished down yesterday, up by 0.3%, but still up above 34,000 and close to its record high. Some of the movers here: BlackBerry up 13.6%. First Capital on news of that sale up 8%. CAE down 3.4%. And Air Canada off by 3.66%. Looking at gold and silver and copper, it's what's gold doing? Up 0.38% at $4,800. Silver pushing $80, up 1.6%. And copper's down slightly, 0.37%. Western Canadian Select yesterday. That upward pressure still carrying yesterday. That was yesterday. Up 3.25% to $72.70 a barrel. Today, WTI, though, it was trading down. Let's see. Yeah, it's still off by 4%. Down below 91. Maybe dropping back down below 90. We'll see what happens there. All right. Right now, one of the most telling signals in the markets isn't the price action in stocks. It's what investors are doing with their cash. We're back with Brianne Gardner from Velocity Investment Partners to see whether cash is king. You almost have to say it that way every time. Cash is king. Is cash king?
Yeah, you know what? It's interesting to see how much cash is on the sidelines right now for investors. And we've actually seen a flood of retail investors start to pile into cash. So as you mentioned, is cash king, or is it a massive mistake for investors? And we believe this was almost one of the most predictable corrections that nobody was really prepared for, or this year, so to say, with all of the stuff we talked about in the first segment, right? It's like there's a lot of noise. We expect volatility in a midterm election year. Usually the first 8 to 9 months are quite flat to volatile. And then we see, the Q4 rally. And that's our expectations. And when you have, strong conviction, and all of the signals and data is showing that, the valuation of tech was super overvalued. The forward P of the S&P 500 was almost 23 times. We like to see that average closer down to 17 and a half, 18 times. And there was a lot of signals that was saying the market was too stretched. So we started raising cash proactively. But in that circumstance, that's a tactical play, right? So raising anywhere between 8 to 12% of cash in our portfolios, we're creating this dry powder on the sidelines. Yep. And to have that is, obviously protects portfolios when we do see a sell-off, and no one knew exactly how long this was going to be, how long this war, what the impacts were going to be on the economy, but we knew it wasn't going to cause a recession, and that is the one thing that derails a bull market. We knew it was going to create volatility, which also creates an opportunity for investors as well. So, and one of the most telling signals in the market isn't what stocks are doing, it's what investors are doing with their cash. So a lot of people believe that, being more and more in cash is actually a contrarian view for a contrarian tell for us as money managers.
They're not being safe. They're just kind of are they panicking?
Yeah, it's a little bit more of an emotional decision, right? And you are seeing that. The fear greed index is that people are feeling that there is a lot of uncertainty right now, and when there is uncertainty, people do flee to sectors like cash, and also gold, silver, copper, which we are seeing. We still think materials are going to continue to do well through 2026. I think it is going to be a leading sector, but that is a flee to safety. And I still think that we're going to see a strong return from the S&P 500 this year. My expectations at the beginning of the year were, 9 to 12%. And I still think we're going to get that type of return from the U.S. stock market. Money market now on the sidelines is over $7.8 trillion. And that was before the market had recovered from the March pullback. So that's hitting all-time highs. And that cash eventually has to flow somewhere. Right? So whether it's coming back into the market, whether it's coming back into the economy, which will boost corporate profitabilities, because ultimately flowing back into the economy and those businesses are going to go up, which ultimately boost the stock market, or it's going to go into real estate and people are waiting for interest rates to come down to start buying property, which again will help to boost the economy. So right now, this cash sitting on the sidelines is actually eating at people's pockets, and not, we know eventually it's going to come back in, but the tale is, when will that be?
And I guess the danger is you can miss it. You can be too safe, and you end up missing out, and you end up losing. Even though you think you're saving, you end up losing.
Exactly, and I think a lot of people, cash has a role for sure. Providing liquidity, being tactical, but also deploying. Like we were very active through this correction. We reduced our cash, on the signals of a potential ceasefire. Started deploying our capital, and now again, markets are hitting peaks again. We're looking at trimming back some of our names and rotating again. So it is a great market for being more active and having an active strategy in this and being selective on the companies that you are invested in. And if you think too longer term, yes, maybe in money market right now in Canada, you're getting 2 to 3%, especially off the back of GIC rates that were, for the past 3-4 years, you were getting way higher rates. And now out of the US, maybe you're getting 3 to 4% on your money market. But if you think of inflation, and the after tax and interest,
it's a wash.
Yeah, it's a wash. Yeah. So you're losing money by sitting in cash and not actually have that money working for you.
How much of your cash did you put back in on this upswing?
So we did about half. So we're down now to probably 5 to 6, and we're also still looking at other opportunities throughout this. Again, taking some profit, even on a short-term rally, there's certain sectors that do well, and where we are in the business cycle is very important as well, right? We think we're later stages of a bull market, top 3 sectors that do well, materials, energy. I still think tech's going to be a leader, but maybe top 4 from a performance standpoint. And same thing in the consumer staples. And those are some of the top sectors that are leading this year. So, I still see opportunities in the market, but I do think you've seen a run up of energy and oil. You've seen a run up of the materials sector. And now you have to be a little bit selective on where you are allocating that
And consumer,
capital.
It feels like there's been a little bit of a pullback, hasn't there?
Yeah, I think you are seeing a pullback in kind of almost all of them short term. But again, that doesn't mean that we still have a lot more room to run in this year. And I think the fear of sitting on the sidelines and trying to time the market and not knowing when to get in, people are waiting for, a 30% correction again. And I just don't see that we're going to have that anytime soon, at least.
All right, we've got to take a break right now, but we'll be back. Up next, shares of Netflix are under pressure in the pre-market as the company's earnings forecast falls short of analysts' expectations. However, the stock is still core holding for Brianne. We'll see why it's on her radar after the break. Time to see what's on the radar for Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners with Raymond James. And Netflix is on your screen right now. And what do you just... It's having a little bit of a rough run today, but what are you liking about it still? Still have confidence in it?
Yeah, I think, we have seen a pullback in Netflix. We saw, leadership making a change as well. So there's a lot of noise around this stock right now. But I actually see this as an opportunity for Netflix and is one that we do have on our watch list to look at adding to that name, especially with this pullback and that 10% that we did see today. I mean, 1 year, it's up about 10.4% because the story, I believe, is shifting back to fundamentals, especially after walking away from the Warner deal. They did really avoid taking on a lot of debt, which is positive. And now we're back to almost, relying on pricing, advertising, and subscription growth. So that's really their story and their sweet spot. And we're already seeing that play out for Netflix. I mean, even since that bottom, that's a great rally up that you're seeing short term. And they've pushed through a lot of these price increases in the US and internationally, which should help to support their revenue near term. But at the same time, a little bit, we have seen some engagement start to soften with viewer hours down to mid-single digits year over year. So, yes, there's a debate on how much more growth is left, but we still see Netflix as a leader in that streaming, space, but the growth is going to be a little bit more moderate. So even if I look at upside, I still think, we're seeing double-digit upside from here.
And Reed Hastings stepping down, any concerns about that? 29 years of the...
I know.
Long time.
Yeah, I mean, I think, change is good. A lot of people fear change, but sometimes change is really good and can actually level up a company. And I think maybe this might be the thing that Netflix needs to take them to the next level, having some fresh meat in there, have a new vision and see where they can take the company. So Netflix still scores, a 9 out of 10 for us fundamentally. And I mean, revenue growth over the 1 year, 3 year, 5 year, you've seen in the double digits. And same thing with earnings growth annualized. So again, this is a stock that I would have definitely on my radar right now.
All right, let's turn to more tech. I guess Netflix is kind of tech, but Broadcom and tech in general. But let's talk Broadcom first.
Yeah, I think Broadcom, has essentially been the stock and name and company that builds the, behind the scenes technology that powers the data centers and AI system. We've seen a nice rally up in the stock there, trading around almost at 400. But what's interesting right now is the scale of what they're doing, right? They just announced a multi-year partnership with Meta, which is great, and Facebook to help build that next generation of AI infrastructure. And it's not a small project here. Mm-hmm. We're talking about, deployments measured in gigawatts of which could translate into tens of billions of dollars in revenue over time. So that tells you AI spending is still accelerating, especially for, some of these mega giants, and companies like Meta are investing heavily into it. And Broadcom is right at the corner of enabling this growth. So again, it's a name I hold and we continue to see upside in because it gives us that exposure, not just in AI, but also in the infrastructure behind it. So that's kind of important. I see about 20% upside from here on the name.
All right, and I want to sneak in Oracle as well, and just tech in general, but let's Oracle.
Yeah, Oracle, in the software company, help businesses run their core operations like databases, financial systems, really managing their data. And really what's interesting is that you haven't really seen Oracle participate there. Yes, we've seen a short-term rally, off this relief cover because I think tech and growth names are going to be the ones that lead us out of this. But, 1 year return, still 33% decent, but Oracle, has now they're integrating AI directly into their systems and more recently expanding partnerships. So they just announced collaboration with AWS, which is great to improve the multi-cloud connectivity, making it easier for companies to use both platforms together. And that's important because companies still want that flexibility, not to be locked into one provider, which positions, I believe, Oracle well in advance. And at the same time, there's always risk, growth tied to concentrated consumer base. But for us, it's not a name that we own today, but it's one that we're watching as AI does move from, still these hype names to real implementation. Yeah.
And tech in general, I was just looking, Intel's up 58% in the last little while. There's people falling in love with tech again. It seems like, the war is over, let's go back to tech.
Yeah, and you do tend to see that, right? That was some of our deployment that we did in our cash. I mean, some of the names, treaded sideways through this correction. NVIDIA, for example, treaded sideways. You didn't really see a big sell-off.
It's been going sideways for a while.
Yeah, and trying to figure out which direction it's going to head. We think higher from here, but it's going to, break out is our thoughts. And then, Microsoft, for example, rolled over. Apple, et cetera. Microsoft was down at 1.25% for 2026. So, we have seen tech and a lot of people taking profits on tech names, and now being a little bit more selective on where they are allocating their capital. So the valuation, the past 3 years, people were piling into the Mag 7, Magnificent 5, whatever you want to call them.
I think I've seen a Mag 10 now, too.
There you go. So, and now people are being more selective. But the one thing that helps us out of any sort of recovery when you see a sell-off like that and valuations come down in tech, which you don't see often, is growth names. Growth names will be the first sector and to rally out of a recovery. So allocating to growth in that pull-off is a great play, which we did for our clients. And one of the shifts right now is that how investors are still approaching tech as a whole, right? We talked about that momentum play to now being selective in, these AI names and what is really paying off. It's going to be more about, their earnings per share growth, their profitability of these companies. And there's going to be clear winners and laggards in that space because not all of those companies are going to be benefiting equally.
All right, we'll wrap it up on that note. There are lots more ahead in the next half hour, including the NHL playoffs are getting underway tomorrow. After the break, we'll tell you how the game doesn't just move pucks, it moves dollars. And our phone lines will open soon for our first call segment. Reach out 1-855-326-6266. Send us an email as well if you're shy. First call at bellmedia.ca. Donald Trump says a deal with Iran may be nearing as a ceasefire between Israel and Hezbollah in Lebanon boosts hope for broader peace. Trump says Iran has made new concessions and suggests a renewed truce may not be necessary, though officials say a full agreement could still take months. Oil prices are easing on the news, with Brent falling even as markets remain focused on the closure of the Strait of Hormuz. Canada-U.S. Trade Minister Dominic LeBlanc says the government wants to resolve trade frictions with the Trump administration as part of a comprehensive agreement rather than through one-off deals. Speaking at the House of Commons Standing Committee on International Trade, LeBlanc said the issues U.S. officials raised privately are the same ones they've outlined publicly. A recent report by the U.S. Trade Representative's Office flagged Canada's dairy system as one of the concerns. Netflix shares are tanking in the pre-market after the company issued a weaker than expected outlook and announced co-founder Reed Hastings will be stepping down from the board. Netflix forecast for the second quarter for profit fell below expectations, and projected revenue as well also missed estimates. The company says its plans to boost spending on content and expand sports programming, even as leadership emphasizes discipline following its failed bid for Warner Brothers. Well, it ain't pretty, but 3 Canadian teams at least are in the NHL playoffs this year. The impact of that goes beyond the ice, although a little lesser this year. New data from Monaris shows playoff hockey can deliver a major boost for bars and restaurants in cities that have teams still in the hunt looking for the Stanley Cup. Joining us now to break down those numbers is Sean McCormick, Vice President of Business Development and Data Services at Monaris. Sean, thanks very much for joining us.
Yeah, my pleasure, Roger. Good to see you again.
All right, let's get this out of the way. Who you cheering for?
Well, I'm originally an Edmontonian, so it's been a fun couple of years. I've enjoyed the ride so far.
All right, well,
maybe we'll get it done this year.
I know see. Florida's not in, right? So there's hope for it.
The path is there, my friend. The path is clear and present.
All right. So what are we talking about? What kind of an impact do the playoffs have for cities, and especially the cities that have teams in the playoffs?
Yeah, it's enormous, Roger. It's such an opportunity for bars and restaurants in particular to find sales where they otherwise wouldn't be there. Specifically like midweek games. It's really tough to get a bar or a restaurant full on a Monday or a Tuesday or a Wednesday. And when you have that kind of event, like that brings a city together and brings a community together, people love to get out and celebrate. And what we saw in the last couple of years really demonstrates that. Montreal in particular, man, that city absolutely gets behind the Habs. We saw in round one last year, citywide spending in bars and restaurants increased 30% in the first home game and 45% in the second home game. So let's put that in context for a second. It takes a lot to move the needle, even 2 or 3% on consumer spending in any category in any given day, week, or month. So when we see numbers like sales up a third on any given night, that's important. It's important for the restaurants, the owners. That's the difference between, again, a midweek where the final, tally on the night might be $3,000 or $15,000. It makes a huge difference.
Sean, as a Oilers fan, do you think this could be, McDavid maybe getting his first cup this year? And then also you talked about the retail space and a little bit on, the bars and restaurants and everything. Is there any other, from a consumer spending standpoint, any other sectors that you see benefiting, travel maybe, or the retail, I know you said hospitality kind of, or is it mainly the bars in these major hubs?
Yeah, no, it's a good point on the travel. I mean, if the Oilers don't make the final, I'm going to save a lot of money this year over the last couple of years. I'll tell you that. So there's a little bit of upside built in there. I'm hedging my bet. But no, it's when it comes to sports and professional sports, it tends to be bars and restaurants. Now, what we've also measured other events like the Taylor Swift shows a couple of years ago. We were seeing like Vancouver apparel sales the day of the show were up of her second show were up 900%. So it all depends on the audience that the event is pulling out to spend, really at the end of the day. And hockey fans love to get out with their buds and their family and just go have a couple of beers, maybe have dinner at the local pub. That's really that's the culture of professional sports fans. It applies to the bars and restaurants.
So what would happen if Taylor Swift got a hockey team? No.
Well, we know there's the tie to football already. I don't know if she could also get a tie to hockey, Raj. But
I think that might get complicated. She could write a song about it, though. Okay, we're digressing. So how? I mean, obviously, the deeper it goes, the more people spend. But there's a limit on money they have. Do we start to see, like in Edmonton? Did you start to see a tail off as they went deeper into the playoffs?
Yeah, it's a good question, and it's that fatigue, financial fatigue, maybe a little bit, right? But the interesting thing that we did see is we can look at data locally, provincially, nationally, really at whatever level we choose to. And when we looked at the national numbers on game nights, as it applies to bars and restaurants, it does nudge up a little bit here and there. And as the Oilers went on that run, the last two runs, what we saw is some interest nationally, enough interest that people would spend, up 2%, 3% on any given game night. But the final in 23-24, the national restaurant, bar and restaurant spend was up 16% in Game 7 2 years ago. And again, context, moving the needle 2 or 3 or 4% is really difficult to do. And it gets more difficult the wider you zoom out. Like when you look at countrywide spend in bars and restaurants, coast to coast on a single night, to get a 16% bump is mind-blowing. And that's what a Canadian hockey team has the ability to do. Listen, hockey, there's a lot of sports in Canada. I mean, the Blue Jays had a good run last year and we saw some, a good bump there. That was really, believe it or not, that was really limited to Toronto. For the bars and restaurants. We didn't see a big lift in bars and restaurants coast to coast. That doesn't mean people weren't watching. They were. The ratings were through the roof. But in terms of capturing the attention of the fans, it tends to happen locally. So when we saw the 16% increase in Game 7 2 years ago between the Oilers and Panthers, that's significant.
And whether, as you mentioned, city specific, whether it's the Habs, the Oilers, or the Sens, is this throughout the whole playoffs, or is it once a team gets eliminated, they kind of drops off from there, or is it, people in these major cities are rallying together through the whole playoffs, watching all of it?
Yeah, I mean, they're the individual cities, like the NHL cities, are cohorts in and to themselves. So we don't really measure that city as its own cohort after the team is out of the playoffs. They end up getting blended into the national number. I mean, I can only speak for myself as a hockey fan. If the Oilers are out and the Oilers can't win the Stanley Cup, I really wish they didn't hand it out at all. Just skip it.
All right. I just want to sneak in one more question when it comes to where people are going to watch the game. Are they at local pubs? Are they watching at chains?
We don't know that, Roger. What I can add to that is that we definitely see a spike in the downtown cores that are the areas closer to the arenas. I guess Ottawa is an outlier because it's out in Canada, but typically what we see is spending spikes around the event, so the stadium or the arena. A lot of that has to do with pregame and postgame, right? The people that are coming down, you got 20,000 fans coming down to the arena. But at the same time, you do get a lot of sports fans coming down to just enjoy the vibe. I mean, we have these, in Edmonton, they've got the Ice District. In Toronto, Maple Leaf Square. We saw the Raptors, the pregame and postgame and watch parties that they had a few years ago. So you end up getting people that want to come down and be part of the event. They might not be able to afford the eye-watering ticket prices, but they can still come down and hang out outside the arena or at the bars and restaurants outside the arena. So definitely some upside there for the bars and restaurants downtown.
All right, we got to wrap things up there, Sean, but hopefully we see an Edmonton, Ottawa, Montreal final. That would be amazing.
Yeah, that would be what we call an outlier in the basement.
Thanks, Sean, for joining us. Sean McCormick, Vice President of Business Development and Data Services at Moneris. Still ahead, today's market drivers with Bloomberg's Janine Panzer. And of course, our phone lines are open. And Ram will take your questions on stocks. Call us at 1-855-326-6266. Email firstcall@bellmedia.ca. Let's take a look at some early market movers. And for that, we're joined by Bloomberg's Janine Panzer. Janine, thanks as always for joining us. Alcoa taking a drop right now as the aluminum producer missed the quarterlies.
Yes, they're taking a drop right now because of the weaker than expected earnings. And it's really not the demand that is the issue, which is why it's interesting, is actually the disruption and rising costs. And the companies cite three things here: maintenance outages, a cyclone in Australia, and ongoing Iran conflict. This one is a big one because it's pushed up energy and transport costs, while also disrupt supply chains. So I want to take a look at two numbers here. It really tells the story. Adjusted earnings came in at $1.40 a share, which is about 70 cents below what analysts were expecting. So revenues also missed as well at $3.19 billion. So even with higher aluminum prices, the company just wasn't able to translate that into stronger financial performance. Roger.
All right, and Ally Financial is up despite a miss.
Yes, Ally Financials are up. And the key driver here is really interesting because even with gas prices soaring, you can see with Ally's story that the lending business, especially in the auto section, the strengths come from there. Strong number across the board for the earnings here. Adjusted earnings came in at $1.11 a share, well above the 90-cent estimate. And also net income was about $319 million, also beating expectations. That's being driven by volume. So the company originated about $11.5 billion in auto loans during the quarter, ahead of forecast. So what stands out here is that demand is still holding up, even with pressure on consumers.
All right, we'll wrap it up there. Janine, thanks very much for joining us. Bloomberg's Janine Panzer. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including what is moving the markets? I have to take a look there. I forgot. GFL is one of the ones that's moving the markets. We'll tell you about that after the break. Let's take a look at some of the notable analyst calls and recommendations. Stifel analyst Shlomo Rosenbaum lowering the firm's price target on GFL to 65 Canadian from 84, keeping a buy rating on the shares. The firm believes the GFL investor narrative is changing due to the secure waste infrastructure acquisition, and it expects the shares to trade at an EV/EBITDA discount to the solid waste peer group. The analyst telling investors that new PT implying a 22% increase from last price. Canaccord Genuity analyst Mark Rothschild cut the recommendation on First Capital Real Estate Investment Trust to hold from buy, PT set to 24.40 Canadian, implying a 2.3% increase from last price. This follows the news. It's being bought by KingSett Capital and Choice Properties REIT. RBC Capital Markets cutting the target on international business machines to 330 from 361 on peer multiple contraction, maintaining an outperform rating though. New PT implies a 31% increase from last price. Oppenheimer also cutting its target for IBM. It went from 380 down to 320. For more on this, let's bring back in Brienne Gardner and get her thoughts on IBM.
Yeah. Yes, I see, you are seeing some cuts on the price target, but I don't really see this as like a fundamental of IBM. I think this is more of an outlook reset on expectations than fundamentals. And IBM's still a leader. I mean, they're cash flow king and they are a cash flow compounder. You're still seeing analysts on the street outperform and buy rating, double digits, about 20% upside from here. And I still think that IBM can run back up to that 300. Do I think it's going to take a little bit of time? Yes, but we still like it because they have reoccurring revenue and sticky clients. The shift to higher margin software, which is great for IBM, continues to play out, and that free cash flow machine. So about $15 billion is expected with consistent dividend growth. So, yes, now I'd say IBM is honestly trading at a discount versus peers, and analysts are calling it, some are calling it undervalued. So again, I see this more of as an outlook reset. And they're still a compounder in that AI infrastructure space, and the market, I believe, is underestimating that transition.
And any concerns with it with software and AI?
No, I think that they're going to continue to do well in that space and continue to be a leader and continue to have that cloud leverage in that infotech space and that knowledge of their business segment. So, being in the software consulting, infrastructure, and finance space, I think IBM, again, at these levels looks to be undervalued for me, and we see more upside in the stock.
All right, we'll leave it on that note there, Brienne. When we come back, Brienne Gardner will take your questions on First Call. Time for First Call and First Email, and that one is from Richie. With all this AI in the future, what is your take on Constellation Software in the future?
Yeah,
this AI stuff.
Yes, we have seen quite a bit of a sell-off in Constellation. If you look at a long-term chart, and even 1 year, two, the stock's down quite a bit. From a value score, still ranks about a 3 out of 10 for us. But I'd like to see a turnaround in this name before adding into it. They still are a reputable name, and I know a lot of people wonder what is the outlook for this stock, right? You can see quite volatile too. Even over the past 5 years, average about 48% in that time range. Analyst target are still expecting though almost 60% upside from here. You're seeing a buyer outperform to a few analysts at a hold, but looking at a price target, quite significant. Targeting over $4,000. So right now it looks like trading around that 2,600. So that's quite a bit of run. But I would like to see what is going to turn this company around, and how are we going to get there? I think they still need to make some changes, and they still do that acquiring, managing, and building kind of vertical market software business. And
it's being punished for that, isn't it?
Yeah.
For the software, the
exactly
apocalypse, right?
Exactly. So, I think that, they still have a great story. And we did see actually recently CIBC lower their price target on software stocks as well. And Constellation was one of those. So it's not a stock that we own in the portfolio. We have it on our watch list, a lot of, great Canadian company, but we want to see a turnaround before I would consider adding or getting into this name.
Yeah. And you said a 3 out of 10. What?
Yeah, we have a 3 out of 10 from a value score and about an 8 out of 10 fundamentally. So again, we look at a lot of indicators and signals to determine, what is where this is ranking. Whether that's earning yields, whether that's book to market, whether that's market cap and sales, adjusted cash earnings yield. We have, a slew of them that we rank each individual stock. And so right now, that's kind of where it falls in our category.
All right, let's get another email in from Paul. Can you explain why many of the Canadian utilities have been scuffling over the last week or so?
Yeah, we still have exposure to the utilities sector in our portfolio from a diversification standpoint. And usually a lot of the good utility names you are still getting decent dividend yields from. Yes has been dragged under, and I think, it's, more of a boring defensive, but now it's starting to become a little bit more of a strategic asset class. So utilities are no longer just, bond proxies, as a lot of people used to pile into utilities for, but they're becoming more of a core infrastructure play as this massive demand for these AI data centers, electrification, grid modernization. This is a multi-decade CapEx cycle, not just a short-term trade. So we do have a bit, exposure, for example, CPX, Constellation Energy, Brookfield Infrastructure, NRG are just a few of the names that we hold in the space. But I think interest rates still matter here. Higher rates have pressured valuations in this space over the last 2 years. So again, if we continue to see interest rates come down, I think you will see a boost from the utility sector as a whole.
All right, we've got about 30 seconds. What's your for this from Al? What's your outlook on Micron's stock price?
Yeah, Micron, not a stock that we own in the portfolio, in that innovative memory and storage solution space. For us, I would say it's a little bit more of a volatile stock play if you can stomach those swings. 6 out of 10 fundamentally. Again, I'd want to see a little bit more conviction out of this name, and has had quite a run up though in 2025. Pull back through this correction. But again, if you are a holder of this name, you have participated over the past year, it wouldn't be a bad time to be taking some profits off the table. You can see 1 year about 500%. So again, for me, I'd be taking some profits.
All right, we got to wrap it up there, Brianne. Thanks as always. Have yourself a great weekend.
Thank you.
Okay, that's it for us here on The Street. Again, thanks to Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners with Raymond James. Andy's up next with the Open. Trading gets underway about 30 minutes from now. Have yourself a great weekend.